So hello, this is Terrence Barkin from the Graphene Council. We're hosting today's webinar on R&D tax credits, a very important subject, especially for graphene-related companies. Today's presentation is going to be presented by David Marnofsky, who's a senior R&D tax credit consultant with Layton, USA. David, welcome. And we're all very eager to learn how we can get these R&D tax credits for companies.
Thank you, Terrence. Appreciate the introduction. First of all, I want to thank Terrence and the Graphene Council for being a great partner, always looking for great strategic partnerships out in the industry. So really thank you, Terrence, especially with companies with this tremendous growth, like the graphene industry. More importantly, at Layton, we want to thank everybody who's signed up for the webinar today and is on the call. Looking forward to providing some tremendous information on research and development. More importantly, you're going to find not only it's going to be very educational, the presentation, but as a tremendous strategy, we have more, find out it's going to be very enlightening for you. So not only educational, but very enlightening. So it's a tremendous strategy that truly can help companies like yourself innovate and grow. So a little bit about myself. Terrence kind of gave me a brief introduction, but David Marnofsky, I'm a senior innovation tax credit consultant here at Layton. About 20 years of experience in institutional sales and investment management, and also some experience on the venture capital and private equity side. So looking forward to presenting to you today and answering any questions that you have. So let's talk about Layton. Layton, we have 22 years of consulting experience. We're a global R&D tax credit specialist, and I'm going to get a little bit more deep into that. We have offices in the United States, and this presentation is mostly geared towards the research and development tax credit in the United States, but I want to make it very clear that we have 22 offices, 27 offices, in 11 countries. So there is R&D tax credit opportunities throughout the world, and we can take care of those needs. So, and we can always have individual conversations after the presentation. But here in the United States, we have an office in Boston and San Francisco. Like I said, we have over 14,000 clients worldwide. And the 22 years of experience really makes us specialists in the R&D tax credit arena. The best way to kind of think about it is the tax code's around 9,000 pages long. We focus on 500 pages. I wouldn't recommend reading the 9,000 pages of the tax code, but we focus on 500 pages. So it's a very niche area of the tax code in regards to the taxes that we look at. Our team here, we have a complete team of senior tax attorneys that have worked for the large firms of KPMG, PwC, et cetera. So they truly understand the tax code and are experts at that. But also what makes us unique is we do have a technical team here. In Boston, we have about 12 technical analysts. The director of the team is an aeronautical engineer. We have biochemists, mechanical engineers, software engineer. We are true experts or specialists at the R&D tax credit. Now, when we look at different industries, we think, okay, where is there going to be tremendous growth? And, where is there opportunities to really have companies utilize and take advantage of the tax credit? So R&D and graphene companies, it's all R&D in graphene at this point. Graphene's been around for a long period of time, obviously, but the use of it, or what we're doing in the industry right now, whether it be examples I can just give you examples of the qualifying industries, which are medical devices, automotive, aerospace and defense, electronics, and flexible touch screens, and the advantages that we're doing on touch screens right now. It's amazing. The energy sector, specifically solar, military, tremendous amount of uses, construction and architecture, tremendous amount of opportunity there. A lot of other companies that are right now, as I look to the people that are signed up for the webinar. Composites, additive for manufacturing, nanotechnology, and many more. I was speaking to Terrence about this when we were creating this list. This list could be 3 or 4 times the size. So basically what I'm saying, what we look at Layton and what we look at in the industry, the graphene industry is growing tremendously, and everything you're doing is R&D, which makes you qualify for the R&D tax credit, which we'll get into. So R&D tax credit. What is it and why now? So coming from the institutional investment side of the business, I look at when it began in 1981 as an institutional advantage or kind of strategy. The R&D tax credit was originally came about in the Economic and Recovery Act tax of 1981. And like I said, it was an institutional investment due to the fact companies like General Motors, GE, United Technologies, they could all take advantage of the tax credit because they had huge accounting teams. It was not permanent on the tax code, so very gray as to what qualified. A lot of, the accounting teams could try and look through the gray to cross the T's and dot the I's, but really not easily identified as to what qualified for R&D. So let's jump ahead to 2015. 2015, President Obama establishes the PATH Act, which made the credit permanent and expanded it to include payroll taxes, which I'll talk about, to benefit startups. You can look back at 1981, mostly institutional with profitable companies. We move ahead to 2015, and it has opened up an incredible amount of companies to be able to take advantage of the R&D tax credit, which I'll talk about. So, do I qualify? A lot of you on the call right now are probably like, okay, what's the criteria for me to qualify for the R&D tax credit? So, number one, has to be new and improved, or a business component. So, pretty self-explanatory. If you're improving on a product that you already developed, or you're obviously creating something new, which in the graphene sector, there's a tremendous amount of new technology in manufacturing, etc. Number two, process of experimentation. Three, and I'm going to explain each of these, the elimination of uncertainty, and if it's technical in nature. So if you fall into these four criteria, you qualify for the R&D tax credit. So let's talk about each one individually. So new and improved. If you have a new product or a process, you've developed new software, if you've created a new formula, any type of making something more efficient, the functionality of it, you've changed, made something with better quality, made something with more durability, added some security to some a product, whatever it may be on its software. And how I related it directly to the graphene industry, and like I said, this list could be 3 or 4 times as long. Anti-corrosion or coatings of paints, efficient electronics. I saw a tremendous amount of technology on battery and supercapacitors, and a tremendous amount of opportunity or new ideas in the construction materials areas. So, number one, new and improved. 2, process of experimentation. And this is kind of pretty straightforward. We've tried different technologies, maybe several iterations or versions that you've tried. And really the best way to explain this when I'm speaking to clients or people who are interested in R&D is prototyping is the best way to explain this, where you developed a product, maybe there's had to be some changes. If you had to, as they say in the old days, go back to the drawing board, that's process of experimentation. So number one, new and improved. 2, process of experimentation. 3, elimination of uncertainty. And what does that mean? That means you have to have a methodology to what you're developing. It has to be an appropriate design. You can't be just throwing a dart at a board and saying, okay, is this the next design that we're going to do? New and improved, the process of experimentation and elimination of uncertainty. And last is technical in nature. It has to be some type of engineering, computer science, or physics or chemistry behind it. But it also can be, we work with a lot of architectural firms, so it can just be really going back to the drawing board or changing something on your BIM modeling, whatever it may be. So new and improved, process of experimentation, elimination of uncertainty, and technical in nature. So now is, okay, what does qualify exactly for our research expenditures? And here at Layton, or in the industry, we call them QREs. So what specifically are we looking at to identify for R&D? So on the QRE, staffing costs. Who is performing the R&D? And one of the areas that we look at when we're speaking with firms is how many engineers do you have on staff? How many on staff are directly performing manufacturing the product, designing of the product, whatever it may be. Staffing costs supporting the R&D. Now, when we're talking about supporting, and obviously our technical team can get a little bit more in depth on this and get granular, but when you're looking at staffing costs, whoever's supporting the R&D, it's not somebody who's just answering the telephone for the people performing the R&D. It's somebody who's in the process, helping out, supporting in the lab, in the manufacturing, whatever it may be. Staffing costs. Now, a lot of times we get questions as to, I'm not directly related to performing the R&D. I'm not an engineer. I'm not a biochemist, whatever it may be. I'm just somebody who supervises. And I'll talk about this. If you're the founder and CEO and you're supervising the people that are developing your product, you're part of the R&D process, so you qualify on the QRE. Use of computers, which is AWS, cloud services, whatever it may be. And this is a question that we get all the time when we're kind of doing an analysis or a scope of study for a lot of our clients are, what about supplies that I consume during the R&D? They do qualify, obviously not everything, but we do have a process that we can look to see what exactly qualifies for the R&D. And then subcontracting costs. This is a question that comes up a tremendous amount of time because of the fact you're a startup, and I'm going to talk about the difference between a profitable company and a startup, which is payroll tax. I'll get into that. But a lot of those companies need to hire subcontractors because they just don't have the bandwidth to bring a staff on. Those costs can be put into the QRE. So let's look at the R&D tax credit overview. As I mentioned, there are two areas where if you are profitable, we call that kind of the standard R&D tax credit, which is state and federal incentive for every technical innovative company, reduces income tax liability on a dollar-for-dollar basis. And I'm going to get into that. I'm going to show you a case study on each. But I'm going to repeat that. Reduces your income tax liability on a dollar-for-dollar basis. Very impactful. Can be claimed in the current tax year and retrospectively for the 3 prior years. Now, that is something that I really want to kind of put a note on, is we can do a 3-year look back, which can be tremendously impactful for a company, which we'll talk about when I show you the case study. Payroll tax credit follows the same criteria that we talked about, that 4 criteria. Only difference is this is for companies that are not profitable. I'm going to talk about the criteria to qualify for the payroll tax. Federal incentive for eligible small businesses. You can reduce your payroll tax liability. Now, let me repeat that. It's your payroll tax liability on a dollar-for-dollar basis, not your tax liability or income tax. It's your payroll tax. Can only be claimed in the current year and be carried forward for 20 years. Now, the additional qualifying criteria for the payroll credit, and I looked at a lot of the companies that are on the webinar, and a lot of the companies are startups or have under 10 employees. You have to be within a 5-year window from when gross receipts were first incurred in the United States. This is, as I mentioned, we are talking about the United States. A lot of this criteria is the same overseas, but sometimes there is a little bit different criteria and things like that. But like I said, we can set up individual meetings after the webinar. So be within a 5-year window from when gross receipts were first incurred within the United States, have less than $5 million in gross receipts in the current year. So now here's something that's very interesting. There's a lot of states, but not all, also have the R&D tax credit. They follow the same technical and qualifying cost rules as the federal credit, and it can be claimed in addition to the federal credit. Now, I always bring this up because it's very, very impactful, is any companies that are on the line that are from California, it is the federal R&D tax credit is the 10% rule, which is a 10% return of expenditures. With California, they are at 10%. So that's a 20% R&D tax credit. But we'll get into that a little bit more granular. So let's do some case studies, because we've gone through, to kind of back up, we've looked at what the criteria is to qualify. We've looked at what the qualifying expenditures are to fund R&D. We've also looked at what the really standard, what the criteria is, the payroll tax credit. So let's kind of get into the what does this mean dollar for dollar. So let's take a standard credit. Now, I'm going to reiterate on this, and I'm going to kind of on this. I picked a company with $10 million in revenue. This could be $1 million in revenue. This could be $100 million in revenue. I just picked easy numbers to kind of do an analysis and do a case study for you. So the standard, $10 million in revenue for this firm. They have 100 employees. Now, obviously, we looked at the QREs. A company could have 200 employees, but only 100 qualify, or 125. Like I said, I'm just doing this for easy numbers, so you can kind of get a great analysis. So 100 employees, and we gave them $50,000 average salary. So now, looking at the QREs that we talked about, maybe we looked at consumables, we looked at computer services, we looked at third-party contractors, whatever it may be. Let's just say we qualified we qualified for R&D expenses $1 million. Now, one thing I want to make very clear is this is not Layton guidelines. This is IRS guidelines. We follow strict IRS guidelines by the PATH Act and the tax code of those 500 pages. So with qualified R&D, IRS guidelines, so we've identified $1 million extra. So easy math. 100 employees at 50,000 is $5 million in R&D for salaries. We've identified $1 million additional for expenses. 5 million plus 1 million is $6 million identified. And as I mentioned before, the 10% rule, 10% federal R&D tax credit. Like I mentioned, this is not Layton. This is IRS guidelines. So this is Uncle Sam, 10% federal R&D tax credit. That's $600,000. For this scenario, that would be a $600,000 tax credit that can be used for the next 20 years. Obviously, if the company's profitable, they usually use it sooner, but $600,000 in a tax credit. So this is where it becomes very interesting, and this is where it becomes tremendously impactful for companies who are not already claiming. Obviously, we haven't claimed the R&D tax credit, but when we really do a nice scope of analysis of their company, we can really get them a tremendous amount of taxes or funds back to them. And one of the things here at Layton, due to the fact with our tech team and our senior tax attorneys, we can usually uncover around 30 to 40% more than most CPAs due to the fact this is a niche for us. So 3-year look back, and I just took the exact same amount that we looked at. Say we identified the 600,000 for 2018, 2017, and 2016. Could be less, but just for easy math, 600,000 times 3, that would be a $1.8 million check back to the company. Now, I want to back up on that. You have a $10 million in revenue, 100 employees, $50,000 average salary. We've identified $1 million of expenditures in the QRE, as they would say. I would be doing the math on the 10% federal credit tax rule. That would be $600,000 in a tax credit for 2019. We do a 3-year look back. The $1.8 million is not a credit. That would be a check back to the company. Now, a lot of clients that we speak with, or even CPAs that we talk to, it's, why would they be giving us a $1.8 million check? Now, the PATH Act basically created what they state as global competitiveness. They want companies who are doing R&D to be taking this credit because of the fact, there's a saying, but innovation is the lifeblood of any economy. Without it, there is no growth. Well, they want you to innovate, and they want you to take these credits. So, global competitiveness. Now, let's talk about, because I know there are some companies that I looked at who are on the call today who, are smaller, maybe 3 to 10 employees, not profitable. Now, one thing I want to make clear is the advantage of the PATH Act of 2015 made it possible for not only profitable companies to kind of streamline the criteria, and make it a lot easier for companies to qualify. The companies that are not profitable can take advantage. So, you have no profit, no gross receipts in the past 5 years. Be clear on that. No gross receipts in the past 5 years, and we can kind of get a little bit more granular on that off the line. But no more than 5 million gross receipts in the current year. So you're a true startup, very extremely not profitable, as they would say. Let's take 10 employees, 100,000 average salary. The reason I brought the salary up for these 10 employees is, as I said, for me, kind of spearhead the venture capital and private equity side here for us at Layton. And a lot of companies, when they are starting up, are trying to hire the best, the biggest and the best, as they would say. So salaries are sometimes a little bit higher. So 10 employees at 100,000. Identified expenses, say we identify another 200,000 for a startup. 10 times 100 is 1 million with qualified expenses of 200,000. 10% rule, that would be $120,000 payroll tax credit. And you have 20 years to use that credit. So back up a little bit. For a company, say they have $1 million in payroll, whatever it may be, and they're 7.5%, whatever it may be, and 70,000 in payroll, you've covered your payroll tax for the year with a credit moving forward. So, a nice advantage for some companies that are just having a startup. So, looking at the standard credit, tremendous opportunity where you're getting an initial credit going forward, but the 3-year look back can be substantial for a company. But also, we can also do a 3-year look back for the payroll tax credit, but it's only a credit. So we can look back, say, and let's just make it easy, say we uncovered a little less, 100,000 whatever for each year. So you could have a $300,000 credit going forward, which when you do become profitable, it might be something that you can use. And talking to a lot of small companies in the venture capital side, they use this as a valuation, add $300,000 to their valuation, or they hold that credit knowing they're going to be profitable in the next 1 or 2 years. So standard credit, profitable, payroll tax credit, not profitable. So what's the Latent process? We've gone through kind of, who Layton is. We've gone through the criteria. We've gone through the QREs. We've gone through 2 examples as to specifically how you can take advantage of this R&D tax credit. So for us, the first process for us is education. We like to have an initial conversation with the company to kind of find out, what qualifies. I just gave a couple of examples. We give examples. Get a little bit more technical to ask, who is specifically involved in the engineering of the new product, qualifying costs, etc. We identify some of the projects that might qualify for R&D. And like I said, our technical team, we call it the initial assessment, but it's kind of a high level as to what could qualify for research and development. And then the investigation side. And I kind of look at education, the identification, and the investigation side. We can do all of this analysis and kind of come up with a rough number for a company, which is kind of looking at how many engineers, maybe some of the projects that do qualify, and we can come up with a number that might make the company say, okay, that makes sense to me. But what we like to do at Layton is we want that to be kind of your decision, where at that point, when we give you a rough number, there is no fee on our side. The only time that it becomes, when we do go forward with a full scope, that is the only time that we do have our fee. So that would be the collection and completion stage. Now, one thing that I want to make clear on the completion stage is that due to the fact we have senior tax attorneys here that follow strict IRS guidelines, and we do have a deep technical team of biochemists, aeronautical engineer, software engineer, they create a technical report for you that breaks down exactly what expenditures we looked at. And like I said, we've been doing this 22 years, since 1997. So 14,000 clients. So we know, that's 14,000 clients worldwide. So we know what qualifies and what doesn't. And then obviously and one thing I want to make clear too is we're consultants, we're not CPAs. I always want to bring that up as kind of almost one of my last points. We are consultants, we're not CPAs. We want to work directly with your CPA on this. We want to be the specialist for R&D for your company and the CPA, if that makes sense. So with that, I'd open it up to any questions, etc.
Okay, David. Well, listen, thank you very much for that. And if we have any questions from our audience, please use the Q&A box or use the chat feature. We don't have any questions just yet, but if you do, please write those and add them in. So, David, I just want to maybe ask a couple questions myself. You mentioned, the last point I think was quite interesting. You don't really replace the internal accountants or advisors for an entity. You provide them advice on how to claim this credit. Does that mean that the tax team for the company that normally does their filings, they would do the filing, but with your guidance? How does that work for the filing?
Absolutely. And I also have Blake Garvey, one of our senior tax attorneys, online. But I'll initiate the answer on that. We're absolutely. For us, like I said, first and foremost, we are consultants, and we want to be kind of the partner with your CPA. The CPA, I go back to my initial statement, but there's 9,000 pages on the tax code. Mm-hmm. We focus on that 500 pages. We want to be that niche or that specialist. So we'll sit down with your CPA. We want to become a partner with them. We want to become a partner with the company. And we want to help them identify exactly what the expenditures are and really supply a complete report to them that really they can file right away. And if Blake's on, I want she can get a little bit more deep on that.
Okay. Well, I appreciate that perspective. Blake, are you there?
I am here. Hi, how are you?
Hi, Blake. Great. Do you want to go ahead and comment to that?
Yeah, just to mirror what David said, we do work very closely with CPAs and internal tax teams to kind of just develop the most beneficial credit that we can for our clients. And it's definitely not a mutually exclusive relationship. We, work hand in hand for the same common goal.
Right. Well, I think this whole topic is fascinating, and I think it's generated the amount of interest it has. It's basically found money, right? So, sorry, I don't know who's got the background noise, but just to say, one of the questions that's come in is, the ability to actually reclaim for credits that maybe haven't been claimed previously. Maybe you want to talk. You mentioned the 3-year look back. So let's say a company's been operating. Let's call it for 5 years, and during that 5-year period, in reverse, it looks like they would qualify for the tax credit. Talk a little bit more about this process about going back in time for credits that they may have qualified for, but they didn't realize it, and now they would like to take advantage of it.
Yeah, absolutely. I can start with that, Blake, if you want to jump in. But yeah, for us, it's always looking back. That's when it becomes tremendously impactful for a company is the 3-year look back. Obviously, from our example, the $600,000 credit in this current year would be fantastic. But if we can look back and look at expenditures or prototyping, or when they went back to the drawing board, whatever it may be. I love to have those conversations with our clients, or, obviously a potential client at that point, but because of the fact we can uncover some, like I said, 30 to 40% sometimes more than there's the average CPA, because this is all we do in the United States is R&D. Now, we also like to keep a long-term relationships with our clients. We're not in this to just do R&D and walk away. We want to be part of that process where maybe in 2 years, you're going to become profitable. Maybe you're already a multinational corporation and you want to maybe take on a new project, or maybe you want to start something new in a year or two. Look to us as a consultant. Blake is one of our senior tax attorneys. She has a tremendous amount of experience working with larger firms and startups. Look to us, ask those questions. What part of this project or venture that I'm going to get into is going to be R&D. And how can I, and what's going to be, how can it go to my bottom line possibly? You know, if you're going to do a project and you know that you're going to get, you know, a $500,000 credit or a $200,000 R&D tax credit from that, it might make you a little bit more apt to get involved in that project. And then to answer your question on the 3-year look back, it's even more impactful. If you have not taken advantage of that R&D tax credit and you can get a hard check back, you know, what are we looking to do as a company? We're looking to grow.
Right.
Hiring more staff, buying more, new equipment, you know, increasing the size of your offices, whatever it may be, it can be used.
Right. And I think it's important to reiterate, because I think there might be a little bit of maybe misunderstanding or confusion. For companies that are profitable, they're entitled then to the standard claim, and that's where you would actually get a check, right? So you would have like a refund or a I don't know what the right terminology is. And for companies that are not profitable, but they get a credit, then that goes against just their payroll taxes. Do I have that correctly?
That is correct. In the current year, oh, go ahead, Blake. Yeah, you can take it from there.
Oh, no, yeah, I was just going to say that, yeah, so in the 3-year look back period, or, you know, if we look back and you have been profitable and you've been paying into income tax liability to the IRS, and we're able to identify any kind of credit, you will get a refund in the form of a check back from the IRS. And then in the current year, any credit that we identify will offset your income tax liability. For smaller companies that fit within certain guidelines, they can use the credit to offset their payroll tax liability. There's also the option of using the credit as a carry forward to offset future income tax liability. So there's so many options available to companies in the way that they can utilize this credit.
Excellent. Now, you know, of course, the Graphene Council, we have members from all over the world, and you guys obviously have offices in multiple jurisdictions. Can you talk a little bit about the typical jurisdictions that do have this kind of a credit system working? And I'm thinking specifically, we have, you know, friends to the north, the Canadians, and in some other countries. Where are tax credit schemes that are like this most prevalent, or that you know of?
Sure. I mean, this is a pretty international credit. To each country has its own version of it. You know, we're obviously the Layton USA, so the United States has a great credit that was expanded in 2015. Canada has a credit. England has a credit. France has a credit. Morocco has a credit. You know, Layton operates internationally, and pretty much any country that a company is located in, we can assist with the R&D in that jurisdiction.
Excellent. We do have a question that's quite specific from an industry perspective, and that would be on solar, which has been, you know, obviously subsidized in different ways in the past. Is there anything special about the solar sector, which also has application with graphene, by the way?
Absolutely.
Sure. No.
Yeah, go ahead.
Oh, go ahead, David.
No, I was going to say absolutely. You know, for us, it's solar has been a you know, we've basically been reaching out to a bunch of solar companies over the past year. So I don't know what this specific question is, but if they're asking if solar development or solar manufacturing is can utilize the tax credit, absolutely. And Blake, I don't know if you can be more specific, but yeah, I mean, absolutely. I mean, that is has been
I can add to that a little bit, just that, you know, solar is a fantastic industry to be able to take advantage of this R&D tax credit. It's certainly research and development in every sense of the word. The IRS also benefits solar companies by offering a solar tax credit, which can be used alongside the R&D tax credit. So you're actually able to take advantage of both tax credits, which is a fantastic advantage.
Excellent. So we have another question that's quite pertinent, I think, and David, you and I spoke about this a little bit yesterday. So you mentioned in your presentation that, you know, let's say a company's operating, they have their internal R&D department, but of course, many companies outsource or do contract R&D projects. So they'll contract somebody to perform those R&D functions. So that's one perspective from the company that is contracting for such services. And then the question that's come through is also related to, what if you're the company that's actually doing contract R&D for, a customer or for a company that's purchasing those services from you, how does that work? Who gets what credit? And is it even possible that both entities somehow can file claims for the work that they're doing?
Blake, I'm going to push that question to you, if that's possible.
Yeah, absolutely. So when we're looking at contracting research and development expenses, it all comes down to the contracts between the two parties. So one of the resources that Layton offers is that we will look at those contracts between our client and their client and figure out, okay, who here owns the actual research and development? Because it can really go either way. It all just depends on the terms between the two parties. And in that respect, that we can determine who owns the R&D and then who's able to claim for the research and development. And there may be cases where, some people own part of the research and development and you can claim part of it and the other party can claim the other part. But again, it really just comes down to what lies in the contract terms.
Excellent. So if I hear you correctly, it's just really important before you actually get into these arrangements to anticipate this and make sure that whatever your position is on that, the contract reflects what you're trying to achieve.
Right. And that's something, that we can act as consultants for you in defining those terms and what makes it most beneficial for you so that you can claim those research and development. So moving forward, we're happy to look at contracts with you and figure out the terms that we should be placing in these. And then looking back, we can look at the contracts that already exist and determine who owns the R&D in them already.
Right. So a lot of the questions and a lot of the focus has been on the retroactive of basically, I get the sense there's companies they've been operating, they may or may not have been aware that these credits even exist. And now that they know that they have them, the question becomes, okay, how do I look back? How do we go back and capture what we might be entitled to? The other thing that occurs to me, especially in the graphene sector where more and more companies will continue to get spun out without doubt, is the concept of actually looking proactively at this. And in particular, because of the distinction you raised in the presentation, David, that once you start gross earnings, and this is another thing that we chatted about, was gross earnings means from $1 up. And when you have those gross earnings, it changes what you can apply for or which approach applies to you. Again, do I have that right? And can you maybe expand?
Yeah, absolutely. Yeah, I mean, Blake can jump in on that also. But yeah, as long as the past 5 years you have not had any gross receipts, and when it's gross receipts, that is any type of income at all. Even if you have a bank account that's generated $10 in interest, if you generated that before the 5-year window, then you're not eligible for the payroll credit. And if you've had more than $5 million in gross receipts in the current year.
Okay. So what I'm thinking is for companies that are in a certain stage, this isn't just looking back, okay, how do we go back and get credits or refunds from previous activities? It could be part of their tax planning strategy, when they want to launch, when they want to go into revenue, that sort of thing.
Oh, absolutely.
So do you help companies with that, with, the forward planning?
Yeah, I mean, for us, we're always, like I said, we're consultants first. And so we always like to, the more companies that we can, as they would say, consult on and help them in their growth strategy, that's great. I mean, you can look at, okay, if a company is within that 5-year window and they know, bottom line, if I wait another year or I do not create any gross receipts, I will be getting a tax credit. Yeah, I mean, that's a strategy. If obviously the business is growing, it's kind of weigh that out. But to answer your question, absolutely, we can consult on that to see exactly.
Yeah. And just to clarify, every company can look back 3 years and reclaim a credit that may have been missed in the last tax years. Only certain companies within the qualifications that David discussed can use that credit for their payroll.
Yeah, and as I talked about with that strategy also, where you can do a 3-year look back and gain a credit, which you can use against future earnings. It just depends on what your bandwidth is, which we can get a little bit more detail with companies.
Perfect. Understood. Well, it sounds like an ideal circumstance where you can engage with a company, take an initial look and see if they're going to qualify or reasonably sure they're going to qualify before you go too far down the road of engagement. And again, this is kind of, I'd look at it as free money, right? It's a tax credit, it's a refund.
Yeah, it is.
So that's, that's hugely valuable. I want to thank you both, David and Blake, for what you've shared with us today. And I really want to encourage those listening to this presentation that if you have questions about this particular approach to tax management, to get in touch.
Yeah, and I'd like to piggyback on that, Terrence, that, for us, look to us as a resource. For us, our process begins with an initial conversation. As you talked about tax strategy or, tax planning, whatever it may be, or, hey, let's look and see, like you talked about free money. If we can uncover some free money for the companies, it's very impactful. They're very, very enlightened. As I mentioned at the beginning of my conversation, the presentation is going to be educational, but more so enlightening for some. So, we welcome the opportunity to get in touch, have an initial call with us, see what you qualify for R&D, and become part of your process. We look forward to that.
Excellent. And for those companies that are located outside the United States, how should they proceed?
Absolutely. They can communicate with us here in the U.S. And as a matter of fact, I just had a client the other day that had an opportunity in the U.K. And I do have individuals that I work with overseas that we can refer that to. But reach out to us here and we can make the referral.
Perfect.
Keep it streamlined and seamless.
Thank you, David. I appreciate that. Well, I want to thank you again on behalf of the Graphene Council. We're pleased to bring this kind of information to our members and our audience. Thank you both for the excellent presentation. We'll be sending out copies to everyone who registered for the event, and they'll know how to get in touch with you. So with that, we're going to conclude today's webinar. I want to thank everybody and wish you a great rest of the day. Take care.
Thank you.
Thank you.